South Africa's inflation rate is edging up, raising concerns that the Reserve Bank may have limited room to cut interest rates soon. Now, although inflation remains within the 3% to 6% target range, it's climbing after hovering near 3% for months. Furthermore, the sub had forecasted a 25 basis point cut in 2025, with more reductions possible through to 2027, but only if inflation holds at 3%. Without government backing for the new target and tighter fiscal policy, rate cuts may become necessary. Meanwhile, Professor Walter Krichel says uncertainty clouds the sub's next move, especially ahead of the September decision.
At the moment, there is some uncertainty about the next repo rate decision in September. The July CPI numbers show the inflation rate drifting upwards, yet the Reserve Bank has announced its intention to pursue a lower target of 3%. Economists are expecting the inflation rate to increase as so-called positive base effects diminish. The annual inflation rate is calculated as the increase between, for example, July's CPI compared to July last year. If the comparison is with a time of high inflation, the increase in the rate is small. That is the positive base effect. But we are now starting to compare with months last year when inflation was already low. In addition, increases in administered prices are still higher than the average rate. Tariffs for water, electricity, refuse collection and sewage increased by higher than 3 or 4.5%. The big question is whether the public sector, which sets the administered prices, will come to the Reserve Bank's party. The alternative is to keep the repo rate high to suppress price increases in those parts of the economy that are sensitive to higher interest